first answer I would say is that the reason we're focusing less on the Federal Reserve is because we're in more of a fiscal dominant environment. So this is an environment where fiscal decisions matter way more. That includes the fiscal deficits, and it also includes things like tariff decisions, because that's a revenue source. That's ultimately kind of a fiscal in addition to a geopolitical thing. And so those parts are just way bigger than the Fed at the current time. The worst case scenario for a central bank is stagflation because it goes against their mandates. Generally speaking, there's a difference for the rest of Powell's term and then whoever is his replacement later. This is sustained. We could see the central bank lose some of its independence over time, become a little bit more beholden. I don't think we're there yet. I don't think we're there this year, for example. The thing I focus on more than interest rates is to some extent the balance sheet, because there are certain involuntary actions that the Fed kind of has to do on occasion, which is if the US Treasury market were to become truly broken, like it was in, for example, March 2020, they have little choice other than to step in and provide liquidity, even if inflation is still above their target. It's kind of an implicit loss of central bank independence because they're not really being told what to do, but they have certain mandates that are so important, like protecting banks, protecting the repo market, protecting the treasury market. They don't really care about 20% stock declines, but they do care about a completely illiquid, messy, off-the-run treasury market, for example. Gradually, they'll go towards stopping quantitative tightening and net go back to gradual balance sheet increases. That could take the form of mortgage-backed securities continue to be rolled off over time and then offset by a similar or greater amount of treasury purchases. I think one of the interesting points to watch will be, so right now, Treasury General Account is emptying. When they get to a point where they want to refill that, there's potentially some hard decisions to make, both by the Treasury and the Fed. And so that'll be where a lot of my attention is, to see how they're navigating that, because I think that's where they might have to provide liquidity, even if they don't potentially want to, because of, prices still growing at a faster rate than their base case. If they get an outright recession, I think, of course, the Fed would cut interest rates. My base case is probably to see rates a little bit lower a year from now. But because we're in such a headline-driven market, it's hard to make any sort of prediction like that with confidence. I think the way I would describe it is I'm not necessarily would have the view that bond yields would keep going up, but rather probably at minimum, they wouldn't go down as much as people think in an otherwise, recession or economic problem scenario. So they don't necessarily provide the ballast that investors would want. And then that view can be exacerbated by hard to predict things like China purposely selling treasuries as one of the tools in their arsenal. So there's Boolean outcomes there for whether certain events happen that could, make yields go up a lot more than we think. But the base case would just be that yields are not giving the offset. So they're not making, things more affordable for people. They're not lowering government interest expense. They're not helping with discounted cash flow calculations. So if bond yields go down, at least you can say, well, maybe equity valuations are allowed to be a little bit higher now. But if bond yields aren't going down, you don't have that offset. They impact mortgage rates indirectly. So you get less refinancing potential, which has an impact on the economy. That's kind of the base scenario, is choppy range bound in yields with potential for disruption should certain events occur, certain kind of intentional events, and depending on how the Fed responds to those attempts, if they happen. Well, I think that the starting point is that if this does, and I think it will, if sustained, slow down global growth, then it can impact a very high percentage of these countries, because even if their trade itself is not the issue, just less global economic activity can still impact them. And supply chains are complex. I mean, things can route through multiple countries and still end up impacting them. Certain pockets are more protected than others. One of the defense is simply that even if they're impacted just as much, if the starting valuations are less extreme, if they're starting at pretty reasonable or in some cases undervalued valuations, and there's not a lot of global capital stuffed into some of those markets, then there's less capital to flee and get scared and go elsewhere. So one of the issues in the US is not necessarily that we're like uniquely impacted, even though we could be. It's that we're heavily impacted while valuations are high. So if Apple was trading more like a value stock rather than a growth stock, the impact might be less severe on it. Maybe that's an extreme example because they're heavily impacted either way. But if you take a typical equity that might not otherwise be directly caught up in the trade war, if it's trading at 15 times earnings, it's a lot less risky than if it's trading at 45 times earnings with a similar growth profile. And I think that's one of the biggest protections you see in other countries, which is that in many cases their starting valuations were not as high. So when you have a bad day of the market, it often ripples everywhere. So there's really no avoiding that per se. But when you look back over a 6-month period or 12-month period, always having somewhat of a mind toward valuations at least helps protect in some of the scenarios. Valuations are those things where they don't really matter until they matter. And these types of events are when they do start to matter. I think in the initial period, so a few months, a lot of companies probably have a wait and see approach, because if you don't even know what tariffs are going to be in 3 months, if you're a small business and you're saying, well, we're impacted, but maybe tomorrow the terms on those tariffs will change. We don't necessarily want to make giant business decisions for things that could change next week. So I think the initial impact is kind of just uncertainty. And uncertainty isn't it itself somewhat bearish, because if you're uncertain, you just kind of take more conservative options for now. Just kind of keep the base case as going, and try not, you're not going to lean in generally. If many companies start to view these as sustained, if this is a new normal, I think over time you'll see elasticity, which is moving supply chains elsewhere, sometimes to the US, sometimes to other countries, which does come at expense, does come at often rising consumer prices or a slowing economy. Many of them are multi-year processes, because if you want to, for example, massively increase US steel production, that takes a lot of energy as well. And shipbuilding, that's a very heavy industry. You need a lot of skilled labor as well. Robots can only get you so far, especially with something like building ships in the current era. And so that goes back to my prior point that the tariffs are impacting immediately, but some of the solutions or routing around those tariffs can take years, or in more extreme cases, decades, to fully change or move things. But at least years is the starting point for how often it typically takes to move the equivalent of a multi-trillion-dollar industrial base somewhere else. Based on the current numbers, these tariffs are a multi-$100 billion tax increase, and a lot of the proposals that they're looking at for tax cuts are not of the same scale. We'll see what ends up being able to get through Congress, but the starting point is that unless these tariffs come down, it's still a net tightening, kind of the fiscal stimulus situation. I would say optically that makes sense for them to take that approach, because on one hand, because this is still in the negotiation phase, everyone wants to appear as strong as possible. So China wants to appear strong, the US wants to appear strong. If you're the political party in power, you want to give a sense of calm. You want to give the indication this is under control, this is well planned, and very well might be based on later accords that could de-escalate this. But the current situation is it's pretty hard to offset the sheer level of tariffs that have now come into play. Uncertainty is itself bearish, because if you're uncertain, you lean out of risk rather than into risk. So you delay things, you pull things, you make those types of decisions. Now, we've not seen, say, a massive increase in the 10-year yield or anything like that. It's not like everything tightened that much, but you don't really have any sort of loosening to offset this so far. And so if you do get higher uncertainty at currently what is a big tax increase overall, that in itself is somewhat bearish. And the issue is mainly that there's not that many offsets. So it's not like this unsurvivable hit. It's just that compared to many other big hits of the past, there's not that many other parts of a portfolio or other parts of the economy that are able to kind of offset that. So base case is slower economic growth, potentially recession. I think it's too early to make that call, unless, again, it's headline driven. That could just be completely reversed next week. But basically, as long as we're in this current state, some degree of caution is warranted. And that's why my approach to markets is really to kind of try to sell some of the volatility, to look for things I'd want to buy at or around these levels, but I'm not jumping in right away because I want to see more policy certainty. Yeah, I do it in an unlevered way, and I do it kind of in the framework of like a long-term investor, which is that I sell cash-secured puts, or in some cases covered calls, but in this market, it's a lot of cash-secured puts, which is to say there are certain stocks I'd be happy to own, maybe not at these current price levels, and so I'm willing to sell a cash-secured put at a price that might be 10, 20% lower, collect what is a pretty big premium in a volatile market, and then not really care about the outcome. If the stock goes down and gets put to me, I view it as kind of buying the dip in a stock that I like and that I've done analysis on, and I'm happy with those valuations and the risk with it. Or the market stays up or rips and I still collect the premium. And I'm like, well, so I didn't buy the dip on that company, but I got paid to take on the potential obligation to buy that. So yeah, when I do selling volatility, it's not those big like levered speculative types of selling vol where you're fine every day and then it's like the turkey at Thanksgiving where you just get wrecked all at once. I do it in an unlevered way for the purpose of reducing risk rather than maximizing profit. If you do tax it somewhere else, if you raise tariffs and keep them up and they're transparent enough so companies know how to actually build and invest to take them into account, then over time they can impact the trade deficit. The main issue is going after kind of the dollar as the global reserve currency. One of the most effective strategies for trying to reduce the trade deficit would be, if anything, to encourage a multipolar currency world, which is to say, maybe not all these global financing contracts have to be in dollars. Maybe if China's making them, they should be making them in Chinese currency. And that could be part of an accord, for example. And so basically you can have the Chinese currency be more used in the eastern part of the world. You can have the dollar obviously be used in our part of the world and the euro in their part of the world. You can have a somewhat more multipolar world that puts less of the imbalances on just one country. But the issue is that, generally speaking, if the goal is to have everything all at once, like you don't want to give up anything about the dollar, but you also want to fix the trade deficits, then you risk losing both or not really gaining ground on either of them. There's going to be tough decisions ahead on trade-offs. This imbalance has benefited some and harmed others. And so the short version is that if you were to swing the pendulum back the other way, there are people benefiting from that, but then there are people who are hurt from it. Many of them will fight back. So longer term, I think that the US can work on its trade deficit, but it's inherently a very multi-year thing. Well, yeah, the advantage that they both have, that they both share, is that they're global assets. So if you do get capital repatriation, so capital coming out of the US, that can hurt US stocks, but doesn't necessarily hurt gold or Bitcoin to the same degree. And the correlation with the NASDAQ, I've done a lot of research on this, and I think the shared correlation that they had is that they were both heavily correlated with liquidity for a number of years, especially in kind of the 2020 and afterward environment. So prior to then, Bitcoin had less correlation with the NASDAQ or the S&P. And starting in 2020, that correlation went up because these big macro forces were just much larger pieces of many asset price swings. And a scenario where Bitcoin can decouple from the NASDAQ is one where you have like tariff-driven stagflation. If the margins of those NASDAQ companies themselves are what's challenged, and yet if liquidity is not heavily impaired, if the Fed goes back to like not doing QT anymore and doing some QE and the deficits remain very large, you can get an environment where liquidity is not that bad, but margins are impacted, earnings aren't going up or aren't going up to the same degree. They're starting from a pretty expensive valuation level. And so you can have a couple years of poor stock price performance while more liquidity-driven assets like gold or Bitcoin that don't have margins to worry about can still do okay. Gold's had a really strong period. The value investor in me is always a little bit wary when something goes up that much, but I continue to hold as a slice of my portfolio instead of bonds. That's one of the things I've tried to focus on, is that I use cash equivalents or gold as some of the more defensive sides of my portfolio rather than traditionally using long duration bonds as many would. And then I treat Bitcoin as a similar exposure that I would in an equity. Whatever percentage of equity I take out and put in Bitcoin instead, and I've been very satisfied with that approach. With a 3 to 5 year view, yes. Because of some of the turmoil in US markets, I wouldn't be surprised when you have counter moves. So I wouldn't be surprised to see US stocks outperform global for the next month or two. I wouldn't really have a view on that. I would defer to traders that are looking at a lot more signals than I am on something like that. But due to the risk of capital flows shifting more structurally, and due to where valuations are starting, and due to the policy shift that we're seeing in our country, I am generally somewhat more bullish on foreign markets in aggregate, or at the very least, I'd want to have a slice of them in a portfolio to diversify my risk of having, say, a 5+ year dead period in the market. If you're spread out a little bit, you reduce the chance of a dead period.